The Fed just raised the rate, so this is what it actually means for the borrowers, savers, and homeowners. So the Federal Reserve raised its target federal funds rate by a quarter percentage point from near zero at the end of its 2 day meeting Wednesday. The first increase in the benchmark rate in 3 years will lay the groundwork for six more hikes by year's end. The war in Eastern Europe gives the Fed reason to act more cautiously, but they will still be working to corral what is already the highest inflation in 40 years, said Greg McBride, chief financial analyst at Bankrate.com. So, how the federal funds rate affects you. The federal funds rate, which is set by the central bank, is the interest rate at which banks borrow and lend to one another overnight. Although that's not the rate that consumers pay, the Fed's moves still affect the borrowing and saving rates they see every day. One single quarter point rate hike from near zero levels will have a minimal impact on household finances, McBride noted. However, this is just the beginning, he added. The cumulative effect of rate hikes is what is really going to have an impact on the economy and household budgets. Long-term fixed mortgage rates are already edging higher since they are influenced by the economy and inflation. The average 30-year fixed-rate home mortgage is now above 4% and is likely to keep climbing, according to Jacob Channel, senior economic analyst at LendingTree. A 300,000 30-year fixed-rate mortgage would cost you about $1,432 a month at a 4% rate. If you paid 4.5% instead, then the same loan would cost $131 a month more, or another $1,572 each year, and $47,160 over the loan's lifetime. Many homeowners with adjustable rate mortgages or home equity lines of credit, which are pegged to the prime rate, will be more directly affected. Most ARMs adjust once a year, while a home equity line of credit or HELOC adjusts immediately. Anyone with a variable rate loan may want to refinance now into a fixed rate, said Mark Scribner, managing director of Oxygen Financial in Boston. There may not be another opportunity. Shorter term borrowing rates, particularly on credit cards, will also quickly head higher. Since most credit cards have a variable rate, there's a direct connection to the Fed's benchmark, so expect your APR to rise within a billing cycle or two. So if you owe $5,000 on a credit card with an APR of 19% and put $250 a month towards the balance, it will take 25 months to pay it down and cost you $1,060 in interest charges. If the APR edges up to 20%, you'll pay an extra $73 in interest. A single quarter point rate increase isn't likely to flip cardholders' financial road upside down. However, all rate hikes, even small ones, are unwelcome news for folks with credit card debt, said Matt Schultz, chief credit analyst for LendingTree. Borrowers could call their card issuer and ask for a lower rate, switch to a zero interest balance transfer credit card, or consolidate and pay off high interest credit cards with a low interest personal loan, shows advised. Even though auto loans are fixed, payments are getting bigger because the price for all cars is rising. So if you're planning to finance a new car, you'll show out more in the year ahead. Car buyers taking out loans for a new vehicle borrowed an average of $39,721 in 2021, an increase of over $4,000 from a year earlier, according to Experian. And as a result, monthly loan payments hit a record high of $644. And to me, this is crazy, right? Like we push super hard in like getting people like out of debt, but look, this freaking amount of money per month going to a car loan payment is stupid. Okay? Like this amount of money over a couple of decades will make you a multi-millionaire if you put this into like index funds, into mutual funds, like into good ones. Like it is insane. It is insane that people are doing this. And not only that, there are so many people who are taking out these types of loans for a car that literally only make this amount of money per year before taxes. Like, it's crazy. You do not get a car loan when you're making $40,000 a year and you get that car loan for $40,000. Like, it's insane. So, a quarter percentage point difference on a $40,000 loan is about $5 a month, or another $300 over the life of a 5 year loan. Still, the Fed's rate increases likely will not have any material effect on what rate you get, said Bankrate's McBride. Nobody is going to have to downsize from the SUV to the compact because of interest rates. Federal student loan rates are also fixed, so most borrowers won't be impacted immediately by a rate hike. However, if you have a private loan, those loans may be fixed or have a variable rate tied to the LIBOR, prime, or T-bill rates, which means that as the Fed raises rates, borrowers will likely pay more on interest, although how much more will vary by the benchmark. That makes this a particularly good time to identify the loans you have outstanding and see if refinancing makes sense as well. So savers get a better return. Now, while the Fed has no direct influence on deposit rates, they tend to be correlated to changes in the target federal funds rate. As a result, the savings account rate at some of the largest retail banks have been hovering near rock bottom, currently a mere 0.06% on average. Even as the Fed starts to raise its benchmark rate, deposit rates will be much slower to respond. Many banks are not going to be passing along higher rates to savers, so where you have your money parked is going to be really important, McBride said. Thanks in part to lower overhead expenses, the average online savings account rate is at least 3 times higher than the average rate from a traditional brick and mortar bank. If you have $10,000 in a regular savings account earning 0.06%, you'll make just $6 in interest in a year. In an average online savings account paying 0.46%, you could earn $46, while a 5-year certificate deposit could pay nearly twice as much, according to depositaccounts.com. However, because the inflation rate is now higher than all of these rates, any money in savings loses purchasing power over time. Look for other options with better rates, advised Yiming Ma, an assistant finance professor at Columbia University Business School, such as money market funds, bond mutual funds, or bond exchange traded funds. There are alternatives out there that will require taking on more risk but come with increasing returns, she said. As long as you are somewhat shielded from recent market volatility, set aside enough cash to cover everyday expenses so you're protected against the big ups and downs, Ma said. The rest can be invested in something that can get a good long term return. And here's the thing, right? This is one of the reasons why people need to stay away from debt so that they don't even gotta worry about any of this crap, right? Because if you're out of debt and you have money in the bank and you have money going towards investments that are going to make you a pretty consistent good return every single year, you're not worrying about this. You're not caring if they're going to raise the interest rate. You're not going to care about this slight increase in cost for like really anything, because since you're debt free, you got an emergency fund and you have money going towards your investments. Everyday expenses is not going to be that big of a thing because you're not going to be living paycheck to paycheck, right? Typically, the people who live paycheck to paycheck usually also have a large amount of debt because they got to service that debt and they got to basically do everything they can to simply just survive. And also, they typically don't really understand personal finance well, so they don't really understand personal finance well. They have a large amount of debt and they are just not making enough money as well. So it's a whole mess of things. That's why just get out of debt, get an emergency fund, start investing for your future, and you'll be golden. But there's so many people in this situation where you are willingly putting yourself in a very risky walls closing in on you by getting into debt, which is scary. So if you want to learn how to get out of debt, go to 40inbox.com.